subscribe now and press the bell icon. Never miss an update.
So return of dependents. We last class, what did we see? That which people can be or who are the relatives or family members or children and all who qualifies in the dependent to be called as a dependent, and there are certain conditions for that. What should be the age limit? What is the residency requirement? Then what else? Relationship. There's one more thing, no? Correct. The total income we need to see. Then if it's a relative, then they need to live in the same house. Then there's one more point. Support point. The maintenance. Right. So now we have seen who will fall under the dependent category. Now let's look into the dependents return. When do they have to file their returns? And then there's something called kiddie tax. Yesterday, as we were talking, this is mostly meant to ensure that the rich people do not push out their income in their kids' name to their kids' name without paying the same rate as if as what they would have paid anyways. So this is the whole strategy. It's not just in US, everywhere people do that, right? They'll do the gifting and all, or maybe put assets in the name of other family members who does not have enough income, and then to get the advantage of the lower tax slab. So we'll go through that. Let's look into this. The standard deduction for a dependent with unearned income. Okay, we know what is unearned income now. By now, everybody knows what is unearned income, right? It is limited to the greater of $1,100 or the amount of earned income plus $350. So first of all, we need to go through that rule. If unearned income, if interest, dividend, any of that income is more than $1,100, that's the first trigger. Okay, that maybe the dependent will have to file their return. So we need to be cautious of that. And then the other limit is the amount of earned income plus $350. That is again the standard deduction which is given. So standard deduction for a single person can go up to $12,000. But here for dependent, we are saying we have to see what is the earned income. You add $350 to that. That is what is going to be standard deduction if it is below the regular limit. If it is higher than $12,000, then obviously we'll stick with whatever the higher limit is. So let's start reading this thing. If the dependent has 1,100 or less, the standard deduction is 1,100. Dependent has more than 1,100, less than 11,850, then we have to see what is the earned income, and the standard deduction is earned income plus $350. We'll do another example. Maybe is there another example given? No. If a dependent has 11,850, then the standard deduction is 11,850 plus this 350, right? So it comes to 12,200. Okay, let's go over the kiddie tax thing. Again, these things will mostly be computed by software. Okay, that we are not going to manually add 350 to it and all, and these limits may also change from year to year. But what is more important to remember is if a dependent is having more than 1,100, 1,200, whatever of income, we need to see if they need to file their own tax return. Okay, so we need to take a call on that. And the dependent may also have earned income. They may go and during summers or during holidays, they will go and provide some services. So that will be earned income. They may get wages or some 1099 income and all. So we'll have to take a call based on that. Do they need to file their own tax return? They can still be claimed as dependent, okay, on the parent's return. So let's see what is kiddie tax. Net unearned income is what we need to see. Again, because kiddie tax is related to unearned income. Okay, so let's focus on unearned income of a dependent under 19 or under 24. We know this clause for full-time student. Okay, at the close of the tax is taxed to the dependent at the parent's marginal rate or the ordinary and capital rates of estates and trusts. So the whole idea is that they should not get any advantage of lower tax bracket because the income is in the name of the kid. Because how would the kid have any income unless the parents transfer the assets in their name? So we are talking only about unearned income. But the kid can have earned income. The kid can go around and do some work, take tuitions, or do car washing, which is very very popular in US. You know, during summer's time and all, they may go and do a lot of chores or clean the garden. You know, pick up the leaves during fall time and all. They can have earned income. So net unearned income is unearned income minus the sum of 1100. This is the first 1100 clause that we can deduct, and then the greater of 1100 of the standard deduction or 1100 of itemized, or there can be certain allowable deductions that are directly connected with the production of unearned income. So there could be some more expenses like commissions and all. If you're paying to earn that income, then those can be deducted. So let's go over this example. We'll go over these two examples and it will be very clear. Who will do this? Rohit, can you please read?
Hello.
Yes, go ahead.
Chris dependent child age 5 has $4,600 of unearned income and no earned income. How much of his income may be taxed at the ordinary and capital gain rate of estates and trust or the parent's marginal rate?
So what we are trying to come up here is we are not we just want to know what is the kiddie tax, or kiddie tax will be levied on what income. So they get a relief of first 100, sorry, $1,100 clause. Then there is a standard deduction of 1,100. So we'll take the total earned income, deduct it, or maybe like, reduce it by these two amounts. Will come up to 2,400. This 2,400 will be taxed at parents' rate, and the remaining income will be taxed at kids' rate. We are not saying that the remaining income is not taxed. Of course, there will be some standard deduction that the person will get and all, which is okay. But what we are trying to compute here is what is the income that will come up to parents' rate. You can continue, Rohit, with the next example.
Melvin, an unmarried individual, age 15, is claimed as a dependent by his parents. He received income of $6450 from earning and had taxable interest of $2300 on a saving account. Melvin's taxable income is $1950, $8750. Gross
Okay,
income.
stop here. So let's just pay attention here so we don't get lost into this. What are they saying is Melvin's income is 6,000. This is his income from earnings. That means he has earned it. Okay, this is earned income. Okay, you can be on mute. And then there is taxable interest of 2,300. So this is unearned income. Right? So what is this taxable income? What we'll do is we'll add up both these income. He's getting a standard deduction of 6,800. Now, can anyone tell me how are we arriving at a standard deduction of 6,800? 6450 plus 350. Good. So this is 6450 of his earned income plus 350. This is what we saw here. Amount of earned income plus 350. Correct? So that's how we are coming up to standard deduction of 6,800. So we will add up these two income, the earned income plus plus interest. We will reduce it by standard deduction. And what do we come up with? 1950 is his taxable income. Now, out of 1950, how much will be taxed at parents' rate? That's what we need to see. So amount taxed at the state or trust rates or whatever, or the parent's marginal rate is $100. Why? Okay, anyone else? Sakshi, can you?
Ma'am, unearned income is 2,300 4,300, and
Good.
less first 1,100 deduction, and then standard
Okay.
deduction 1,100 again.
Correct. So this is applicable for only unearned income.
On an
And this
income.
is the same calculation. This we are doing only to figure out what is the tax on at parents' marginal rate. Okay, so that's why we are doing this, and we are saying that okay, $100 is coming up after deducting these 2 times $1,100. So $100 will get taxed at parents' rate, which can be much higher, and the remaining 1950 is total taxable income. So out of that, $100 will get he'll pay taxes say at 30% because parents are paying 30%, and then maybe on 1850 he's paying taxes at say 10% because he doesn't have any other income. Okay, because this is the remaining now after taking out $100. Is that clear?
Yes.
And Muskan, Vinita, Ayush, is that clear to you guys? Okay, so now they are giving example of what is unearned income and all. Anyways, we have seen this earlier also. This is just a recap of what we've already gone through. This is all the kind of passive income, income coming from any investments can be considered as unearned. And there are certain exceptions, social security and all, or scholarships. Those are not considered to be income. So those are not considered to be earned income and all. And kiddie tax does not apply to an 18-year-old dependent if the dependent had earned income that exceeds one half of dependent support. So what they're trying to say is like if the dependent himself or herself is so smart that he or she is earning enough to take care of 50% of his own support, that means there is some real ability in that kid, right? So there's no, it's not like he's earning income only because of his parents. So that's where they're saying, okay, the kiddie will not apply kiddie tax to that kind of person because he's putting in enough efforts and having an earned income, which is good enough, which is high enough to take care of 50% of his expenses. And tax on a dependent is the sum of that's fine. Regular tax at single filer, unearned kiddie tax at okay. This we have already seen that. Okay, any questions here? That's a very small chapter, just talking about how do we derive the income which is supposed to be taxed at parents' rate, and what is going to be the remaining income, and how do we apply standard deduction for a dependent. Then we'll go to the next one. Let's start with 1.6. So this is about non-residents and dual status alien. We need to be careful here. We need to pay attention to this because this dual status will come up a lot of times. We keep getting those inquiries and we'll have to see if dual status approach needs to be applied for those kind of clients. So let's see what is dual status alien. A taxpayer is considered a dual status if the taxpayer was both a non-resident and resident during the year. And this is very common. People are moving on visas from one country to US, or maybe they are going back. So that is not necessarily it's happening on the first day or last day of the year. No, it can happen anytime middle of the year. To see if they fall into the dual status alien category. Okay, then generally a taxpayer is considered a resident alien if either the green card or substantial presence test. This is important, either the green card or SPT. This is called. This is again an important term. Substantial presence test has to be met. Or the person is having green card, then no questions. We don't even need to count how many days the person is there and all. And even if the taxpayer does not meet either of this test, so this is a flexibility given by US government to taxpayers saying that, okay, you don't meet the residency test. But if you want, you can always file as a resident. Is that possible, Shweta? Is that possible in India? Like if a person is non-resident, can he or she file as ROR?
No.
Can we not have that, can we not make that selection that I need to file as ROR only, or will they be, if it comes up for audit, will they reject it?
But what is the point? I mean, the taxpayer will be at loss, right, if he shows himself as a resident when he is NRI.
Right. Yeah, that is scenario. That scenario is applicable in India, but that's not the case in US. Because if a US person shows himself as a US resident and all, they get higher standard deduction. They may get a lot of child tax credits. They may get other benefits and all, and which can actually decrease their tax liability, even if they're putting worldwide income for taxation. And we have seen that happening in a lot of cases. That's why we cannot just completely ignore like how we will do it in India. That what is the point of reporting worldwide income, because you'll be paying more taxes. So now what is green card test? Like any resident who is having green card at any time during the year, he would have given a green card like sometime in the year, but then doesn't matter. Anytime during the year, if you're having a green card, you can still go with, can still say that you passed the green card test and you can call yourself as a resident. Who is a non-resident alien? Or sorry, what are the rules for non-resident? A non-resident may file a joint return if she is married to US citizen. Now again, this is like typical to US only, because that's where they're filing joint returns and all. So IRS will give that flexibility that, okay, if you're married to somebody who is a US resident, then even though the spouse is non-resident, the spouse can elect to be taxed as a resident. If the couple files a joint return, both spouses are treated as US resident. Either they'll have to file a joint return. In that case, they don't have a choice. Both have to be treated like a resident, or they can go with married filing separately or head of household or some other status. But usually, if they want to go with filing, then the other spouse, who is technically a non-resident, will be considered a resident. And that, what does that mean? If a non-resident is saying, okay, tax me as a resident, then this is where the clue is. They have to be taxed on worldwide income. Okay? A taxpayer is considered unmarried for HOH purpose if the taxpayer's spouse was a non-resident alien. Yeah, so if the taxpayer is saying, well, we don't want to I don't want to show my spouse as a resident and all, then it's fine. IRS is saying, okay, we'll consider you as unmarried for the purpose of filing tax return, because the spouse is filing as a non-resident and all, or you are not choosing your spouse to file the taxes as a resident. So for head of household purpose, he can be considered, but a spouse is not a qualifying person. Remember, what are the conditions that we saw for HOH? There has to be a qualifying person, right? How can a person be head if there is nobody under that person? Right? Remember, that's what we looked into. Why not single status, or why not something else? Like head of household is given only if there is a dependent for the taxpayer. And that dependent, we saw that there were certain conditions to that dependent is called qualified individual for the purpose of HOH. It can be a child, it can be a relative. We already went through all those conditions. And but spouse, what we really need to pay attention to here is spouse is not considered as a qualifying person. Spouse will not take spouse as a dependent. So the person cannot say, well, I'm the HOH. Why? Because I have a spouse and I'm incurring 50% of more of the expenses for the household and all those things. That doesn't count. It has to be a dependent. And spouse is not considered a dependent even though spouse is not earning money or whatever, because they're married. A taxpayer must have another person who needs to be qualified as a dependent. Then only the taxpayer can get HOH status. Even if taxpayer is considered unmarried for HOH purpose, because the taxpayer is married to a non-resident alien, the taxpayer, okay, what they're saying is if you need to calculate earned income credit, you can still take, married filing jointly status, because the earned income credit is not applicable for any other status. So again, then that's a call that they need to take. If they want to take earned income credit, they'll probably have to file joint returns. Okay, so that's like, I mean, because earned income credit is, sorry, given only to married filing jointly status. Now there are certain other benefits that only residents get and non-residents will not get. Okay, we'll go over this separately. But what they're saying is non-resident aliens can deduct certain itemized deduction. Non-resident aliens can get itemized deduction. Usually they don't get standard deduction itemized, but if they have any income which is coming from US, any expenses which is related to that income, US income, then they can deduct it. There could be some state or local taxes that they're paying, or some other, like, losses, charitable, whatever like falls in itemized category, they can still take benefit. Otherwise, they are not allowed. Otherwise, even standard deduction is not allowed for non-residents. A non-resident is not eligible for any of the credits and all. Most of the benefits are not allowed. But non-residents are required to file a return. They are definitely, that's the rule for everybody. If you are having income which is effectively connected with US, then US would want you to file tax return. Anyone can apply, any foreigner can apply for ITI and they can get a tax identification number, and you apply, file the return as a non-resident. Most type of US source income will be subject to a tax rate of 30%. So again, this is some kind of hardship for a non-resident, that mostly they'll be straight away taxed at 30%. So US is not giving that benefit what a resident would get. Any scholarship, fellowship and all, for activities conducted outside US is not subject to US taxation. So even though there could be a US university giving a scholarship, but let's say the scholarship is given to some German person, is residing in Germany and doing work there only, then that is not connected effectively. There's a word here that they use. Yes, it is not effectively connected with US trade or business. Okay, so then it is not subject to US taxation. So here, what is important, what is takeaway from here is, when we come across a person who is half year resident, half year non-resident, the person could be single or married, or the person could have a dependent, we need to take a call, what is the best possible scenario, okay, when it comes to the taxes for that person. Because US IRS is giving that flexibility that even if you are not a non-resident, you can file as a resident. Filing as a resident will give a lot of benefits, credit, like a different kind of credits and all. But the downside is the person has to report worldwide income. So if the person is having really huge income outside US, then maybe they should not go for residency thing. Right? Try to avoid that. It depends on person to person. Like, we have to take a call keeping into mind all these rules. Now we'll see what is substantial presence test. This is usually applicable for people, those who are an H1 or F1 and all. F1 is usually non-resident, but people, those who go on L1 visa, H1B visa, will they be considered as resident or not? Are they satisfying this condition? SPT, substantial presence test. So what is the condition? That they need to be physically present in United States for at least 31 days during current year and 183 days in last 3 years. And how do we come up with 183 days? It's not like straight away we'll go and count 183 days. This is little bit, they made it little complicated, where they're saying is, you take full 100% of days of 2019, the current year, then 1 year preceding that, we only take 33% or 1/3 of the number of days, and then we'll take 1/6 of the number of days for the third year that we are talking about. Starting from the current year as the first year, then going back second year and third year. This is how we need to calculate if we are coming up to 183, and there is a clause called and, right? So if they have both, the condition need to be satisfied. then we can say that the person is satisfying SPT. Then there is no going back, and then it's not like we get a choice. We have to file as a resident, and the entire worldwide income is subject to US taxes. F bars could be applicable, 8930, everything would be applicable. Otherwise, F bars are not applicable for non-residents. But for dual status, again, it's just safer to do F bars. Then ending resident status, look like, if a spouse is choosing, even the spouse is non-resident, this happens very, very commonly. There's so many people living in US, just take example of Indians only. They've been living for last many years, studying and, doing job and all. They come back to India, get married in India, take the spouse goes over there. And so that's very common, what status we should choose for the spouse. And this is not just Indians, like the US you have people coming from all over different countries. Not necessarily they marry there only. Usually, they go back to their country, get married and come back. And also we always have to see these things. So they can choose the spouse to be resident, or they can even end the resident status of spouse. It doesn't mean if they've chosen once, they cannot end it. There can be certain conditions, there can be certain situations where they can end, like if there is a death of the spouse, or if they went through divorce, or if there is a legal separation that has happened, or the last thing is inadequate records. If you don't have proper records of non-resident spouse income from their own country, if it's not possible to get proper record, then IRS can also revoke this, the flexibility which is given, saying that, okay, there are no proper record. That means you're not able to properly report worldwide income. So you might as well just revoke that status. And in that case, both of them, one of them can file as a resident, one of them can file as a non-resident, or married filing separately, or whatever. Okay, the Internal Revenue Service, IRS can end. I hope everybody knows the full form of IRS, no? Is there really someone, maybe Ayush and Rohit, maybe you guys, now you must be knowing. We keep saying IRS, you guys should know what is the full form. You guys knew it? No. Okay, but thanks for being honest. Yeah. The IRS can end the choice for any tax year that either spouse has failed to keep adequate books, records, and other information to determine the correct income tax liability. Or even if they think they have adequate record, but they're not able to provide it to IRS, then IRS can take an action saying that, okay, we don't give that resident status. Okay? Any questions? With this, we'll end.